Canada's economy is often described as a distinct entity, yet its deep integration with its southern neighbor raises a persistent question. How independent is it, really? This investigation explores the intricate economic ties that bind Canada and the United States, examining the extent to which one nation's economic health is intertwined with the others. We'll look at trade, investment, and shared industries to understand the complex relationship that has shaped both economies for decades. Understanding this dynamic is crucial for grasping Canada's unique position in the global marketplace. 1. Introduction. Is Canada truly economically independent? The question of Canada's economic independence is a complex one, often debated with varying interpretations of what true independence entails. At its core, economic independence suggests a nation's ability to make its own economic decisions, control its resources, and operate without significant external influence or coercion. This involves a degree of self-sufficiency in production, a stable currency, and the capacity to withstand external economic shocks. Canada's economic relationship with the United States, in particular, is a primary focus when examining its independence. The two countries share the world's largest bilateral trading relationship. This deep integration means that economic conditions in the U.S. inevitably have a profound impact on Canada. Fluctuations in American consumer demand, interest rates, or trade policies can ripple across the Canadian economy, affecting everything from resource exports to manufacturing output. Furthermore, a significant portion of Canadian foreign investment originates from the United States. While this investment fuels growth and creates jobs, it also means that key Canadian industries are often owned or significantly influenced by American corporations. Decisions made at corporate headquarters in the U.S. can therefore have direct consequences for Canadian operations, employment, and economic strategy. However, Canada also possesses considerable economic strengths that bolster its autonomy. It commands vast natural resources, maintains a diversified economy beyond its U.S. trade ties, and has its own independent monetary and fiscal policies. The Bank of Canada sets interest rates independently, and the Canadian government manages its own budget and taxation. These factors allow Canada to chart its own economic course, even while acknowledging the deep interdependencies that exist. 2. What economic independence really means. Economic independence, in its most fundamental sense, signifies a nation's capacity to sustain its own economic activities and development without undue reliance on external forces. This means possessing the resources, infrastructure, and policy-making autonomy to direct its own economic destiny. It's about having the ability to set national priorities, manage trade relationships on favorable terms, and respond to domestic needs without being dictated by the economic agendas of other countries. Consider the concept of a trade surplus versus a trade deficit. A nation that consistently exports more goods and services than it imports is generally in a stronger economic position. This allows for the accumulation of foreign currency reserves, which can be used to invest in domestic industries, pay down debt, or buffer against global economic downturns. Conversely, a persistent trade deficit can lead to increased foreign debt and a greater susceptibility to external economic pressures. This dependency can manifest in various ways, from relying on foreign capital for investment to being subject to the pricing whims of international commodity markets. Furthermore, economic independence involves control over monetary policy. A country with its own currency and an independent central bank can adjust interest rates and manage the money supply to suit its domestic economic conditions. This is crucial for managing inflation, stimulating growth, or stabilizing the economy during crises. If a nation's currency is pegged to another, or if its monetary policy is heavily influenced by external actors, its ability to respond effectively to its own unique economic challenges is significantly curtailed. The historical context of many developing nations illustrates this point. Many formerly colonized territories found themselves economically structured to serve the needs of their colonizers, often specializing in raw material extraction with little processing or value-added industry. This legacy created a long-term dependency, making it difficult to diversify economies and achieve genuine self-sufficiency. Reversing such dependencies requires deliberate policy choices aimed at fostering domestic production, building human capital, and securing favorable international trade agreements. 3. Trade dependence between Canada and the United States. Canada's economic landscape is deeply intertwined with that of the United States, a relationship characterized by significant trade interdependence. This connection is not a recent development, but rather a historical pattern that has evolved over decades, solidifying over time. The sheer volume of goods and services exchanged daily between the two nations underscores the critical nature of this economic linkage. A substantial portion of Canadian exports finds its destination in the American market. Sectors such as automotive manufacturing, energy products, agricultural goods, and natural resources are particularly reliant on U.S. demand. For instance, the integrated North American auto industry means that parts and finished vehicles frequently cross the border multiple times during their production cycle. Similarly, Canada's role as a major supplier of oil and natural gas to the U.S. highlights a profound energy interdependence. This reliance means that fluctuations in the U.S. economy can have a direct and immediate impact on Canadian industries, employment, and overall economic growth. Conversely, the United States also benefits from and depends on Canadian trade. Many American businesses utilize Canadian raw materials and manufactured components in their own production processes. The proximity and established infrastructure facilitate efficient cross-border commerce, making Canada a vital trading partner. Disruptions to this flow, whether due to policy changes, logistical challenges, or economic downturns in either country, can ripple through supply chains and affect consumer prices and business operations on both sides of the border. The nature of this trade dependence presents both opportunities and vulnerabilities. While it provides access to a vast market for Canadian producers and a reliable source of goods for American consumers and industries, it also means that Canada's economic performance is significantly influenced by external factors originating south of the border. This interdependence necessitates careful economic management and strategic planning to navigate the complexities of such a deeply integrated commercial relationship. 4. The role of energy resources and exports. Canada's vast energy resources, particularly oil and natural gas, significantly shape its economic landscape and its relationship with global markets. The extraction and export of these commodities represent a substantial portion of the nation's export revenue. This reliance on energy exports means that fluctuations in global energy prices can have a pronounced impact on Canada's trade balance and overall economic performance. For instance, periods of high oil prices have historically boosted Canadian economic growth, while price downturns have presented challenges. The geographical proximity and integrated energy infrastructure with the United States create a particularly strong economic linkage. A significant percentage of Canada's energy exports, especially crude oil, flows south of the border. This interdependence means that U.S. energy demand and policy decisions directly influence the Canadian energy sector and, by extension, the broader Canadian economy. Economic dependency, in this context, can be understood as a situation where one country's economic well-being is significantly tied to the economic activities or resource demands of another. Different regions within Canada experience varying levels of direct impact from energy resource development. Provinces like Alberta, Saskatchewan, and Newfoundland and Labrador are heavily reliant on the oil and gas sector for employment, investment, and government revenue. This regional concentration of resource wealth and its associated economic activity can lead to differing perspectives on national economic policy and trade relationships. The revenue generated from these resources often supports public services and infrastructure across the country, illustrating a complex distribution of benefits. The global transition towards cleaner energy sources presents both opportunities and challenges for Canada's energy-dependent economy. While the demand for traditional fossil fuels remains substantial, investments in renewable energy technologies and sustainable resource management are becoming increasingly important. Adapting to these global shifts requires strategic planning and investment to ensure long-term economic stability and competitiveness, potentially diversifying export markets and domestic energy production. 5. Currency policy and financial systems. Canada's currency policy and its financial systems are deeply intertwined with global markets, particularly those of the United States. The Bank of Canada, responsible for monetary policy, sets interest rates, and manages the money supply with a primary focus on maintaining price stability within Canada. However, its decisions are often influenced by or made in consideration of the Federal Reserve's actions south of the border. This interdependence means that while Canada operates its own monetary system, its autonomy is constrained by the economic realities of its largest trading partner. The Canadian dollar, or loonie, floats freely against other major currencies. Its value is influenced by a multitude of factors, including commodity prices, capital flows, and interest rate differentials. While this allows for flexibility, significant fluctuations can impact Canadian businesses and consumers. For instance, a sharply depreciating loonie can make imported goods more expensive, contributing to inflation, and conversely, a strong loonie can make Canadian exports less competitive on the international stage. This dynamic highlights a dependency where external economic forces can exert considerable pressure on domestic price levels and trade balances. Canada's banking sector is highly concentrated, with a few large national banks dominating the landscape. These institutions operate under federal regulation, ensuring a degree of stability and consumer protection. Nevertheless, the interconnectedness of the North American financial system means that crises or significant shifts in the U.S. financial markets can have ripple effects. The operational frameworks and regulatory oversight, while Canadian, are designed with an awareness of this close proximity and integration. This can lead to a degree of policy alignment or at least a need for close consultation and coordination during times of financial stress. Furthermore, the flow of capital between Canada and the United States is substantial. Canadian pension funds invest heavily in U.S. securities, and U.S. investors hold significant stakes in Canadian companies and government debt. This two-way investment creates financial linkages that influence exchange rates and the cost of capital for both nations. While this integration offers benefits such as access to larger capital pools and diversification opportunities, it also means that Canadian financial institutions and markets are not entirely insulated from economic developments in the United States. The stability of the Canadian financial system, therefore, is implicitly linked to the robustness of its U.S. counterparts. 6. Military and strategic economic ties. Canada's defense procurement and industrial base are deeply intertwined with that of the United States. This integration is often framed within the context of shared security interests and the practicalities of North American defense. The two countries cooperate on numerous defense projects, from the development of military equipment to joint training exercises. This collaboration naturally fosters economic linkages, as Canadian companies often supply components or services for U.S. defense contracts, and vice versa. The North American Aerospace Defense Command, NORAD, serves as a prime example of this deep strategic alignment, necessitating a high degree of interoperability and shared technological investment. This close military relationship has tangible economic consequences. Canadian defense manufacturers are significant players in the U.S. supply chain, contributing to employment and technological advancement within Canada. Conversely, U.S. defense spending indirectly supports Canadian industries through these interdependencies. The rationale behind such integration often centers on cost sharing and the avoidance of duplicated research and development efforts, which can be prohibitively expensive for individual nations. This strategic partnership allows for greater efficiency and capability development than either country might achieve alone. However, this strategic economic interdependence raises questions about the degree of genuine independence in Canada's defense-related economic policy. Dependence on U.S. defense contracts can influence Canadian industrial strategy, potentially directing investment and innovation towards areas that align with American military priorities. This can create a situation where Canadian economic policy, particularly within the defense sector, is indirectly shaped by the needs and decisions of its larger neighbor. The long-term implications of this reliance are a subject of ongoing discussion and analysis within economic and defense policy circles. 7. Corporate ownership and foreign influence. A significant portion of Canadian corporate ownership rests with entities headquartered outside of Canada. This foreign ownership can manifest in various sectors, including natural resources, manufacturing, and financial services. For instance, many of Canada's largest companies, particularly in mining and energy, have historically seen substantial investment and control from foreign corporations. This creates a complex web of economic ties where decisions impacting Canadian operations and employment may be influenced by global corporate strategies and shareholder interests located elsewhere. The degree of foreign influence is not uniform across all industries. Sectors like telecommunications and broadcasting have specific regulations designed to limit foreign control, reflecting a desire to maintain Canadian sovereignty over key communication infrastructure. However, in other areas, foreign direct investment is actively sought as a driver of economic growth, job creation, and technological advancement. This dual approach highlights the ongoing debate about balancing the benefits of foreign capital with concerns about national economic autonomy. This ownership structure can lead to situations where profits generated within Canada are repatriated to foreign parent companies, potentially impacting the domestic reinvestment of capital. Furthermore, the strategic direction of subsidiaries operating in Canada can be dictated by decisions made at international corporate headquarters, which may not always align perfectly with local economic conditions or national policy objectives. Understanding these dynamics is crucial for assessing the extent to which Canada's economy operates independently. The presence of foreign-owned corporations also influences Canada's international trade relationships and its position within global supply chains. These companies often integrate Canadian operations into their broader international networks, affecting the types of goods produced, the markets served, and the sourcing of raw materials and components. This interconnectedness means that economic trends in other countries can have a more direct and immediate impact on the Canadian economy than might be the case if corporate ownership were predominantly domestic. 8. The idea of the 51st state explained. The concept of Canada becoming the 51st state of the United States is a recurring, albeit fringe, idea that surfaces periodically in discussions about North American integration. This notion is not a formal political movement, but rather a hypothetical scenario explored in certain academic circles, think tanks, and sometimes within public discourse. It often arises when considering the deep economic and cultural ties that already exist between the two nations. Proponents, or those who explore the idea, often point to the significant level of cross-border trade and investment as evidence of a de facto economic union. The integrated nature of supply chains, the free movement of capital, and the shared cultural influences create a scenario where some argue that full political integration might be a logical, or at least a plausible, next step. This perspective tends to focus on the potential for streamlined economic policies and the elimination of remaining trade barriers as primary benefits. Conversely, critics and those who dismiss the idea emphasize the distinct national identities and political systems of both countries. They highlight the historical development of Canada as a separate nation with its own unique institutions, laws, and social values. The argument here is that economic interdependence does not automatically translate into a desire for political assimilation. Furthermore, the potential loss of Canadian sovereignty and the fundamental differences in governance, healthcare systems, and social safety nets are significant concerns that are rarely overcome in these hypothetical discussions. The idea, therefore, remains largely theoretical, a thought experiment rather than a concrete political aspiration. 9. Arguments for and against economic independence. Arguments for greater economic independence for Canada often center on the potential for increased national control over resources and policy. Proponents suggest that a more self-reliant economy could allow for tailored development strategies, unhindered by the economic priorities or potential pressures from a larger, dominant trading partner. This perspective highlights the ability to direct investment, regulate industries, and set trade terms according to Canada's own long-term interests, fostering unique Canadian industries and innovation. Conversely, arguments against significant moves towards economic independence frequently point to the substantial benefits derived from deep economic integration. Critics argue that severing or substantially reducing existing economic ties could lead to reduced trade volumes, higher consumer prices due to less efficient production, and a loss of access to capital and technology. This viewpoint emphasizes that Canada's current prosperity is, in part, a product of its open markets and strong trade relationships, particularly with its largest neighbor. Economic dependency, in simple terms, means that one country's economy is significantly reliant on another for trade, investment, or financial stability. For Canada, this often translates to a heavy reliance on exports to the United States, making its economic performance sensitive to shifts in the U.S. market. This can limit Canada's flexibility in setting certain economic policies, as it may need to consider the potential reactions or impacts on its major trading partner. The debate also touches upon the concept of economic sovereignty. Those who advocate for greater independence believe that true sovereignty includes the power to make independent economic decisions without undue external influence. This often involves discussions about diversifying trade partners beyond the current dominant relationship, strengthening domestic industries, and ensuring that national resources are managed for the benefit of Canadians first. However, the practicalities of achieving this in a globalized world, with established interdependencies, present significant challenges and potential economic trade-offs. 10. Conclusion: what the future may look like. The trajectory of Canada's economic relationship with the United States, particularly concerning potential shifts in independence, hinges on a complex interplay of global economic forces and domestic policy choices. One plausible future scenario involves a deepening of existing economic ties, driven by evolving trade agreements and North American supply chain integration. This could manifest in increased cross-border investment and a greater reliance on shared industrial sectors, potentially blurring the lines of distinct economic policymaking. Conversely, a future characterized by a more assertive Canadian economic strategy is also conceivable. This might be spurred by a desire to diversify international partnerships beyond the U.S., seeking new markets and investment opportunities in Asia, Europe, or other emerging economies. Such a pivot could involve targeted industrial policies aimed at fostering uniquely Canadian innovation and competitiveness, thereby strengthening its independent economic footing. Another perspective suggests a future where technological advancements play a pivotal role. Automation, artificial intelligence, and the digital economy could reshape the nature of economic interdependence. If Canada can successfully position itself as a leader in these transformative sectors, it could gain significant leverage and reduce reliance on traditional commodity exports, a cornerstone of its historical relationship with the U.S. Ultimately, the future economic landscape for Canada will likely be a mosaic of these potential developments. It is improbable that a singular path will be followed. Instead, a dynamic evolution is more likely, influenced by external global trends, the strategic decisions made by Canadian policymakers, and the ongoing evolution of its relationship with its largest trading partner. The degree of perceived independence will be a function of how effectively Canada navigates these multifaceted influences. Canada's economic landscape, while robust, is undeniably intertwined with its larger neighbor. The flow of goods, services, and capital across the border creates a dependency that shapes domestic policy and market dynamics. From historical trade agreements to modern investment patterns, the U.S. influence is a constant factor. Understanding this relationship is key to grasping Canada's economic present and future. So, while Canada maintains its distinct economic identity, the question of true independence remains a complex one, shaped by decades of integrated commerce. What are your thoughts on this economic connection? Let us know in the comments below. Next time, we'll explore how Canada's resource-rich provinces navigate global commodity markets and their unique ties to international demand.